Afternoon, everybody. This is Chrissy from Solstice ATR. Hope everybody's doing great. You can check us out on Twitter, Discord, or YouTube, and you can hit the subscribe button if you like and enjoy this video. Let us know what you think. So first of all, let's take a look at the overall major indices. And what I'd like to do is examine similar sharp rallies of major bear market lows from the 1950s till 2021. And the reason behind it, because I'm going to use a relative isolator indicator to show us where those events happened in relationship to those different instruments. We're going to look at some electronically traded funds, some futures, Bitcoin, the dollar, and inflation. Make sure to be flexible in your understanding of trading. Don't be biased to one side. That way you don't get caught on the wrong side. Trade the charts in front of you. So once again, take a snapshot of this. That way you can get an evaluation of the overall market. Remember, this is for illustration use only. We're not a broker-dealer. Past performance doesn't indicate future results, and I hope this will help you in the coming week to understand day by day or week by week what the market can do for us. Okay, I will show you some other stuff after this on the rate of return and the overall historical charts. So first of all, I want to begin using BTC, that is Bitcoin futures that's traded on the exchanges. And what I'd like to show as of March 2021, we have been rallying higher. We've got a couple of gaps from the holidays, from the new year. Then in February, we have another gap here. And we recently made one in March as well. We have not visited. If I put these on the daily charts going to a 4-hour chart, that will show the overnight actions in there. We have continued in a linear regression channel. We have a monthly fib high and low. We retested the 50% monthly fib and continued higher. In the last, basically, last day 1, day 2, day 3, day 4, day 5, day 6, day 7, we've been going side range in Bitcoin. What I want to let you know, be open mind if there's going to be a change in the linear regression channel in the 18 SMA and the 50 starting to get away from the range on the daily chart. So be open mind to change in BTC relative to momentum, supply and demand. We have developed a couple of POCs in this area and a couple up here. So remember to be not biased. Make sure that those two channels are not broken to continue higher. If this channel is broken in the 18 SMA, I would look for the reset back down in this area. So let's now go to take a look at some of the bond market inflation stuff. I want to start with the ETFs. First of all, I'm going to take a look at the 10-year TNX. I believe it's the 10-year Treasury Index ETF. As you can see, as of January 4, since the stimulus package got approved, they were talking about inflation increasing interest rates for the bank to be profitable. Interest rates spiked up last couple of days from March 10th to 1.75, 1.76. This is very important. We're above 1.5%. I hope they keep it steady in this range. They don't increase it more because it'll cause a reaction in interest rates bearing account short-term maturity products from 2, 5, 7-year, 10-year. When you go get a loan, it's going to cost you more on that interest rate. If I look at the inverse relationship to the yield, we can use the IEF, and I'm using these ETFs to give you a better idea in relationship. This is showing you the 7-10-year Treasury price of the bonds have spiked down since March 10th. You can see it when we came down, lifted, came back down. And this is the reason why I put these on the chart, showing you the gaps and the momentum since January 4th that move dramatically straight down. Do we stabilize here? Possibility. So be open mind to change in the interest bearing account. This is why I brought this up, to show it to you. And if I go back to the TNX one more time, I'm going to go to a weekly TNX. Oops, TNX. And what I'm going to do, instead of going to daily, I'm going to go daily. Instead of 3 months, we're going to go, we're going to go from daily to weekly, and we're going to go 3 year and push OK. So we can see from 3 years ago that the spike down from here to here was a very major event till March. As of March 2020, the spike down has caused, we can use a Fibonacci fan to show you, like we drew the highs and lows where the 50% fib is, where 61 will act as resistance, and the 200 SMA and the 225 simple moving average. I can grab the peak from here to down here, and we can see that the 23, 38, 50, 61, we're sitting right on it. And on the 61, there's a 78 up here. Do we get resistance in this area to come back down? Because if we break this area, this is going to be very dramatic on inflation. This is the reason why I put this up next to, after we finished BTC and I showed you the IEF. We're going to look at the technology right now. The XLK, that's a NASDAQ, because you can look at the NASDAQ 100 and the technology companies such as Tesla, Amazon, Shopify, PayPal. We can see we spiked up since the March, pandemic, February, 20th, February 18th throughout March 23rd, and we continued very high. We are in a small reset. We have retested the 18 SMA. Does this hold? Because there may be rotation in the market or not. Keep an eye on it. Let's take a look at the QQQ. And we can see it's in a similar situation. I only have the monthly fib on it. We can take a look at XL, the health sector XLV. So you can see in the same situation since March, we had the spike down, move up, and I put the monthly only fibs on it. And this is the reason why. Keep an open mind to change. Don't be biased, because there may be rotation in markets, from technology, healthcare, to consumer products, staples, smaller, mid-sized companies, to keep us intact in the market. I can take a look at the IWM small cap as well. Let's take a look at it. And this is the last probably ETF I will show. You can see that the Russell, since the February, eventually it took quite a bit of time to eventually break out, in September, and then in October, November, it rallied in December. We have continued a little bit more higher than the NASDAQ 100. So people started moving into small cap. We do have this professional gap down here. What we can do is basically to learn a little bit more on it. We can put a box here and put a text between here and here, and extend it here. We can right click on it, edit the triangle, and just go a couple of days to the right side. You can see that we can do this, so it'll show up, and we can do that. Oops, did it show? Okay, it did it a couple of times. Hold on, one more time. We'll make it a little bit bigger for a couple more days so we can see in relationship where it is, that gap when we're coming back down. We are away from the 18 SMA in this major channel on the small cap ETFs. So let's first of all start by looking at the NASDAQ NQ, which is the E-mini contract for the NDX. As you can see, I have the annual fib from low till December. We have it highlighted. So instead of the weekly, we're going to go to a smaller time frame, and we're going to break it down bit by bit. We're going to go, instead of 3 year, we're going to go to a 6 month. We're going to look at it on a daily chart in relationship to what the market is doing. We know that the annual high in December was here. That was the annual high. And we have looked up in January, came back down in February. We looked down here and we spiked up here. We eventually fell down a little bit more than usual. We are more in a compressed symmetrical triangle in a channel, trying to hold on to the weekly fib. The most important thing in trading, we have to keep an eye on the annual high. If we don't, we can retest at 12,500. I am not biased to being bearish or bullish, but we have to keep an open mind on change in the NASDAQ 100. As you can see, the February low was here. The February high was up here. And I have drawn the last week's fib from high to low in the last 2 days when we got the engulfing candle that overtook the last week and a half change in trend to the upside. Do we find a linear regression channel here? Do we find support to continue higher? Possibility. I am not saying we have to. We retested, from the high and low, this 38.2 or the 61.8. Does this reverse to continue higher, or do we fall back into the range of the NASDAQ a little bit lower on the monthly extensions of the 38%? This is why I showed the weakest one. Let's take a look at the ES, which is the ES mini, which is the SPX or the SPY ETF for the fund. As we can see, we're still in a linear regression channel continuing higher. We have the annual high right up here that happened in, where is it? This should be it, I believe. Yep. This is the 31st. We can see that the annual high was 37.53. We have retested it in February. What we're going to do is zoom in here and take a look at the month in February where the highs and lows were. We came down here in February 1st to the highs up here. We retested the 59. We reclaimed it last week 3 times going above it because we tested that was the 58 quarter, I believe, or 58.50. Let me see, what was it? 58.50. Then we fell a little bit. We continued high and we broke out here. Basically, we can call this 1 top, 2 top, 3 top, 4 top, 5 top, 6 top, and eventually we looked above and failed. Is this a clean top? Possibility. But is the trend changing? Maybe. If not, we're still in that linear regression channel. We are holding the 50 SMA. This was a major channel from before. My eyes are actually on the 38.2, which is the 38.70 to hold. If next week we cannot hold it, I would look for the extensions to the downside, or I would look for a reversal continuing higher. So this is why I showed those two, because there's rotations in the instrument. Let's take a look at the YM. As we can see in Dow Joe 30 companies such as Boeing, Exxon, oil companies have done very well. In the last couple of months, we continued higher and we rallied. But what I want to make sure that the February Fibonacci highs and lows, are we going to hold it to continue higher? We do have a professional gap. On the NASDAQ, we filled it. The S&P, we filled it. But the Russell filled it, but the Dow Jones Industrial Average have not filled this gap from the prior months. This is very important. We broke out of this weekly fib. This is no longer the weekly. I had it on the prior days, which I forgot to remove it. We broke out of this channel to continue higher. I do have a linear regression channel between up here and up here. We are away from the 18 and the 50 SMA. Is it possibility we can come back to consolidation of the range in February? Yes. Does it mean that we're going to continue higher? Possibly not, but be open if this engulfing candle that took out those last 5 days, which we're still holding this major candle up. This is the weekly fib from high to low. As long as I'm above it, I'm bullish. If I'm going to lose it in order to continue lower, I'll look for the 18, the 38, and the 61% fib, which matches, the fib from high to low, and that's the 61, and that's my 38.2 fib for first support on the Dow Jones Industrial Average. Let's take a look at the ES one more time. As we can see, the ES annual, I went over it earlier, but what I want to do, make sure that you understand that the 50 SMA, we tested the 18 and bounced off it on the daily. Do we hold here or not? Because my 61.8 is down in this range in the 3800 area, okay? Let's take a look at AAPL. That's Apple. You can see it's in a downtrend. If I look at Amazon, it's in a downtrend, in a symmetrical triangle in a linear regression channel in order to get it moving out of there. If I look at Ford looked up, still holding the annual fib 50% extension to the upside from the annual high. If I look at General Motor, it's in a similar situation. If I look at X steel, because I'm going to show relative instruments that use steel manufacturing, you can see the price of steel has spiked up as well. If I look at Boeing, BA, you can see that Boeing had a nice rounded bottom, and eventually on that order, this is the February monthly fib, high and low, we eventually broke up, came back down, but we are continuing to see if this channel will hold us on an annual linear regression channel from way back before. On the weekly chart, we can see that the charts were in a symmetrical triangle from the February annual high down to the move, and we eventually trying to reclaim it. Boeing looks to be interesting if it holds this linear regression channel to continue higher. You can reposition yourself around the 250, 235 area, going back up, to the higher range of the $300 in the future in Boeing. Let's take a look at Zoom, ZM. ZM is meeting a linear regression channel. This is the monthly fib. Zoom coming back to this area where the consolidation was from before. I'm keeping an eye on this area on the monthly and the annual chart from before to see if I can catch a wave back up in Zoom. And this is the reason behind it why I'm looking at Zoom. If I look at Netflix and FLX, we can see Netflix on the weekly chart is holding its levels, and I have to be able to understand in relationship to where I am in Netflix on a daily chart. 3 month, does that hold or it does not? So what I'm going to do, go to the daily instead of a 3-year weekly. We're going to go to a 3 month, and instead of a weekly, we go to a daily to see in range if it is coming back in that symmetrical triangle. If it falls, we look for the extension of the 61.8 to catch its breath. Netflix. If I look at Google L seems to be range bound since the earning report here, holding up. We retested the prior 3 lows at the 1900, trying to hold. If Google holds the 20, 25, 20, 30 and continues back up, I'd like to see a breakout of this linear regression weekly fib channel to the upside. Unless it falls through the 50, then eventually I'll look for the 61 and the gap fill of this candle in Google. Let's take a look at Tesla. As we can see, Tesla is in a symmetrical triangle as well, holding up. It's holding the 116 SMA. If Tesla cannot hold, I would look for the 23% fib. I don't like this kind of a pattern, but I'm watching. You can put a linear regression channel here. If it's going to break up, then continue higher on the weekly charts. So remember, if you need any assistance to help you out, and this is the reason why I want to put the SPX last, and I'm going to show you the historical on rate of change and where I came up with those numbers for the charts and the Excel sheets. So we're going to go from a daily chart to a time frame of maximum time frame on the charts, and on the maximum time frame I'm going to go from daily to monthly charts to show you the relative strength and the movement that has happened prior to all these moves that has happened in the market. And what I want to do, show you in 1933 in June, this is the rate of change where we had that depression in the market. There was no other condition except in 1983, 81 and 2008, 2009, 2010, when the relative change has changed in 2020, 2021. These relative changes that has happened in the market. This is the reason why I want to show you the spikes after a major decline and after a rally back up. The rate of change declined a little bit, but we continued on a good path in an upside till 1987. But in 1987, the rate of change never happened here before. It never peaked that high ever again. Then we had a similar situation 2008, 2009. You can see the 2001, 2000 Twin Towers. You never had the rate of change at a peak. Then we fell down in 2003. Then we continued higher. From 2003, we reclaimed, the 2008, and eventually we fell back down to that spike down in 2009, 2010, after that relative major, credit crash in the real estate and the bubble that happened. We had eventually, after March highs of 2020, a nice relative move back up in the market, and eventually we had the pandemic in 2020 February. We had that major event that happened here. If I zoom in just from here to here without taking a look at the item, we can see that spike up there. We fell back down, then eventually we rallied way higher to see that move up in that area on the monthly chart in the SPX in relationship to that major COVID-19 spike down. Then eventually I rally back up. And on the monthly chart, you can see that the candle's still positive. Is there going to be major change in the market? We have to be open-minded and fluid in it. And I will show you the reasons why I am showing you this, because historically, we can have a spike up or a spike down in the market in relationship what the outcome can be. After that major event, we can have a bumpy ride of a 12% or a 15, 16% decline in the market to look at a 4-year, 3-year historical average rate of return in order to receive, a 71% in 5 years, 4 years, 72, in 3 years, 38. And maybe in the first year, maybe we don't do anything in 2021. But these are the major events I have put using the rate of change by looking at the S&P 500, because it does not represent all the market, but it represents the major 500 companies in the US and American depositories receipts that are traded on the exchanges. So I hope this was helpful, and I look forward to seeing you at Solstice ATR or on Discord. If you like this video, let us know. Hit the subscribe button and smash the like button. Take care. Over and out. Enjoy your weekend.